Hello everyone and welcome to this video. I will show you in a simple way on how to make money in stocks, specifically swing trading. I've been trading for over 3 years and I have constantly outperformed the Nasdaq index, and I've used this exact method to do it. And I will show you it and you can do it too. So before we go into the more details, I will just cover the basics with a few slides here. So what is swing trading? It's a trading technique generally associated with technical analysis in which the trader seeks to profit from short-term price swings. So you want to have a stop loss always, because you don't want to just destroy your portfolio. And a stop loss order works like this. You buy at this point, let's say $100, and you put a stop loss at this level right here, let's say $90. So if you buy it here and the stock wobbles and it goes into sideways like this, nothing will happen. But if the stock touches this point here, it was $90, right? The stock will automatically sell. So in that way, you protect yourself from the downside, and you should not have a stop loss more than 8% below your purchase point. So below this point and this point shouldn't be more than 8%, because as further down you go with the percentage, the more upside you need. So for example, let's just take a dramatic example. If you have 50% downside, you need 100% upside, and that's the way it works with percentage. So if you have a 15% downside, I don't know, but maybe you need a 20% upside, so it's not linearly. I read this book, How to Make Money in Stocks by William O'Neill. I highly recommend it. I've gained a lot of knowledge in trading and fundamental analysis and technical analysis. I will put a link to in the description, and you can buy it on Amazon for just a couple of bucks. It's very worth it, and it's on covering a very specific, or very, I would say, a very general strategy, which is the canceling strategy. I think you should approach every stock with this mindset. Whatever the stock you buy, if you want to trade or for the long term or whatever. The canceling is very easy because each character tells you one component that the stock needs to have before you buy it. So the C, so it says canceling here, and the C stands for current quarterly earnings should be at least 25%. That's a must. And you need annual earnings growth at least 25% too. That's for the A, and at least 17% return on equity. I will show a stock later that fills all these criteria. And the N stands for new products, management, or services. It needs to launch some new kind of product or have new management or etc. The S stands for you want to see low supply, it should says there, and high demand. I will show you on the technicals what that means, but it's generally like a chart pattern you want to see. And the L stands for leader or laggard. Of course, by the leader. So in a sector, you want to watch for the strongest stock in that sector. So for example, if you look at the solar sector, you want to find the best stock in the solar sector. That's the leader. And the I stands for institutional sponsorship by funds, banks, etc. This you can look this up just by the charts, by the volume and price action, but there are a few websites that you can check this too. And the M stands for market direction. It should be in a clear uptrend. All right, let's get into it. So here we can see the revenue growth. It has a clear uptrend. You want to see good fundamentals for the last 3 quarters. That's also tells you in the book, but the canceling just puts the easy things for you in a easy, comprehensive way. But in the book, it also says that the 3 last quarters should be exceptionally good and growing. And here we can see that the It's growing with 15.7%, 22.8%, and a 33.3%. So this is the revenue growth. This is something you want to see. You want to see an acceleration in revenue growth in the last 3 quarters. And the earnings growth, you also want to see the exact same thing. So here we have negative 66.7% and 52.9%, and the last quarter 100%. If you remember the criteria, the C, it said for current earnings should be up at least 25%. So this is up 100%. So this is acceptable. And yeah, then you can just take a quick look at the profit margins. It also says in the book, not in the canceling, but in the book, they tell you to look at the profit margins too. It's at 25.9%. You want the profit margins to be at least at the highs. You don't want to see like this 4.7, like it's to the low end. You want to see at the all-time high or at near all-time high. Okay, and yeah, that's pretty much it about the fundamentals. It's more into it, but I will. You have to read it for yourself in the book. But this is the basics of it, and also you want to see the return. Let's see, this one, return on equity, 16.9%. So it said 17%, right? So this is close enough. You want to see this number at 17% at least. And that's pretty much it. If your stock have these components, it's a really good stock. It's growing like crazy, and most of the rest numbers will take care of itself, like the P ratio, don't care about that, or the EBIT growth, like you can see here, the operating income, and you can hear all these investors like talk all crazy about like different different ratios and all kind of stuff. But if you look at these components that I have shown you now, most of the rest of the numbers will take care of itself. Okay, so that's pretty much it. And for the technicals, sorry, let's go for a LGM and look at some technicals. So the How to Make Money in Stocks book that I have linked in the description, it always tells you about the cup and handle. It's a short pattern that I very often trade. It's the cup and with handle and the VCP pattern. I will show you the cup and handle right here. So this is the same stock as the fundamentals, and the cup with the handle is like this. You have probably heard about it before, but this is a perfect cup with handle setup. We have the volume coming down at the bottom. That's something you also want to see. It's not mentioned in the canceling, but yeah, it is. Sorry, that's what I mean. It's the supply and demand. You want the supply go down substantially in the bottom of the cup. That means that there are no sellers left. And you want to see an acceleration when the stock price moves higher, as we can see here. The volume is huge and the price action is also huge. That means that a lot of money is pouring into the stock. That's something we want to see. It's most often institutional buying right here. This is not private investors, because this is way too much money. This is like funds and institutionals that is buying this stock. So for example, if we talk about the risk reward ratio, if we were to buy the stock right here, right? If you can see this here, so we buy the stock at about $36.5. We want to set the stop loss at not more than 8%. So this is 7.35%. So this is acceptable. We put it right under the swing low, the intraday low on here. And then we want to see the risk reward ratio be at least 2. So here it is 3. You can find this in the trading view. It's free to sign up. I guess you already is using it, but if you click here, you can click on long position, and then you will get this one. It's very easy to use and it's very nice. So if we take the buying point here, we put the stop loss right here. So if the stock touches 33.9, then the stock will sell. And if the stock reaches about 44.5, the stock will also sell, but to a profit. So this is a risk reward ratio to 3. This is a perfect trade. Why? Because the fundamentals are great. Just for 15 seconds. Revenue growth accelerating in the last 3 quarters. The earnings growth acceleration in the last 3 quarters. The profit margins is at all-time high. And the the return on equity is at 17%. So we have the fundamentals and we have the technicals, and with a cup and handle with nice supply and demand. So this would be a perfect trade, and I will show you another one just quick. I found this just a few days ago, and this is also this is nice VCP pattern, by the way. But now we're talking about the cup with handle. And yeah, now we have the cup with handle right here too. It looks like that. And we have very nice supply and demand. We have the volume coming down as the price action is tightening up. That's good supply indicator. That's no supply coming in, there's no sellers. And on green days, we see a spike in volume. That's something we want to see. And we see a tightness in the price. So if we were to do a trade, I would buy the stock right here at this big candle. I would put a buying stop loss, not a sell stop loss. So a buying stop loss. So if the stock reaches here at $7.15, if the stock reaches that point, I will buy the stock. So I will buy a breakout from a small base here, and I will put the stop loss right around there. So 7.13%, and I want to have a risk reward ratio of about 3%. So this would be also a perfect trade. So, and this is not like something that I sugar pick or something. This is trades that I do over and over and over and over again, and it's worked for me for at least 3 years. I have outperformed the Nasdaq. So this is no like fantasy or some weird crazy thing. I am buying stocks that are growing, so it is good stocks, and I combine it with some short pattern. So I get the best of two worlds, sorry. And the risk reward ratio, because of we put it 3-to-1, then you can afford to lose more trades than you have profitable trades. So for example, you can like lose 6 of your 6 of 10 trades and just go profit for 4 of 10 trades, and you will still be at the profit. So that's the best thing about the risk reward ratio. You need to find a strategy, like it could be a specific type of stock you're buying or a specific short pattern. And I'm using the cup with handle and the VCP pattern with great fundamentals. I put the link in the description if you want to buy the book. It will give you a huge amount of knowledge, and it will probably one of the best investment you can do. And yeah, that's pretty much it. I hope you enjoyed the video. I've given you some very valuable information, and yeah, that's pretty much it for this video. Take care, bye.